So Dave, I'd like to start off with the stock market. The S&P 500 rose 28.7% in 2021 on the back of 2020's 18.4% gain and 2019's 31.5% gain. That's a compound annual rate of return of just over 26% for the last 3 years. In fact, the stock market has returned 16.5% over the last 10 years, with only one down year back in 2018. How long can this possibly last? And do you really think the market can go up again in 2022?
Yes, well, as you know, Joe, Wespath doesn't try and predict the direction of the US and world stock markets. We have a disciplined, long-term strategy, and we'll continue to adhere to this strategy. But you're right. We've seen exceptional gains in the US stock market over the past 3 years, 10 years, and yes, again, last year. The S&P 500 declined just 1 year in the past 10 years, and that was only a decline of about 4.5% in 2018. What's more, the average annual return of 16.5% that you cite substantially exceeds the low single-digit returns that many prognosticators were predicting just 10 years ago. Now, the first chart that I'm showing looks at US stock market returns over the last 25 years. The blue bars represent the total return for the S&P 500 for the specified year, and the red triangles represent the largest drawdown or peak to trough decline for the specified year. The last time we had a prolonged bear market was when the tech bubble burst back in 2000. And except for the abbreviated bear market that occurred with the great financial crisis of 2008 and early 2009, the market has provided really generous returns since 2003. Now, there's one other feature of this chart that I would like to highlight, and that's the peak to trough decline in 2021. From early September to early October, we saw the markets decline a little over 5% as inflation appeared to be more transitory than the Federal Reserve hinted that it would be, and that it indicated that it was going to be more aggressive at that time in fighting inflation. But that decline was just the second smallest peak to trough decline in the last 25 years, second only to the least volatile year ever, which was just 5 years ago in 2017. Now, I do feel compelled, Joe, to try and put some of these market gains into perspective. You spoke earlier about the valuations of the large infotech companies. When I prepared my remarks for today, there were 7 infotech companies that comprised 26% of the S&P 500. Apple, Microsoft, Google parent Alphabet, Amazon, Meta, which is the new name for Facebook, Tesla, and NVIDIA. Now, for our viewers that may not be familiar with NVIDIA, it's a technology company that manufactures hardware and semiconductor units used in gaming, automobiles, and components for supercomputers. This chart looks at the average 5-year returns for each of these infotech giants. One certainly must question the extent to which these infotech giants can continue to grow at these rates. The market value of Apple recently exceeded $3 trillion. The New York Times reported last week that Apple alone is more than the combined market value of Walmart, Disney, Netflix, Nike, ExxonMobil, Coca-Cola, McDonald's, AT&T, Goldman Sachs, Boeing, IBM, and Ford, again, combined. Now, I love Apple products, and I'm embarrassed to say how many Apple products I own, but $3 trillion? That's a valuation that is really difficult for me to comprehend. So back to your question, Joe, about whether one could reasonably expect increased market gains in 2022. It's difficult for me to expect continued leadership from the 7 companies that make up more than a quarter of the index. That said, corporations buying back their own shares could continue to provide the overall market with continued gains. The next chart looks at share buyback activity over the last 17 years. Buybacks for the third quarter of 2021 set a record, with S&P 500 companies purchasing 235 billion of their own shares. And all indications are that buybacks in the fourth quarter will match or exceed the third quarter's record. Companies will typically scale back repurchases during periods of economic uncertainty. We saw that back during the great financial crisis and again at the onset of the pandemic. So if we continue to see a reasonably strong economy in 2022, then one should expect to see continued share buyback activity, which could lead to more positive results for the stock market. All that said, it's extremely difficult for me to perceive that we will see returns anywhere near what we've seen for the last 3 years.
That's some great perspective, Dave. And I'll note that you said that buybacks would likely continue if the economy continues to grow. So let's talk about economic growth. What are your prospects for continued US and world growth in 2022? And also, what do you think might interfere with continued growth?
Sure, I'll start with the US, Joe. We won't see the first reading on fourth quarter GDP until January 27th. On the left of the chart, we show the Atlanta Federal Reserve's GDP Now forecast for the fourth quarter. They are predicting the economy grew at an annualized rate of 6.8%, which means that the overall economy would have grown by 5.5% for the entirety of 2021 when adjusted for inflation. That was pretty close to the forecast made by the International Monetary Fund in its World Economic Outlook at the beginning of the year, and that was 5.1%. On the right side of the slide, we show current projections for 2022 for the US and other parts of the world. The numbers here represent the median prediction from over 40 reputable sources. Presently, economists are predicting that the US economy will grow at an inflation-adjusted rate of about 4% this year. And while that's lower than other parts of the world, it's really not unexpected given that our economy bounced back better than most other economies did. Now you ask, what might interfere with continued growth? And I think we all know the answer, and that's inflation. That said, I do think some wonder if another more deadly variant of COVID could wreak havoc with the economy. In fact, last week, we saw over 5 million workers call in sick because of the less deadly Omicron variant. And because of this, economists have already begun to lower their first quarter growth forecasts. But it does look like inflation is going to stick around for a while, which could lead to more aggressive action from our Federal Reserve to fight it with the risk of slowing the economy.
So let's dive deeper into the inflation risk, Dave. The consumer price index increased 7% in 21, which is far higher than anyone predicted. Now, why is it so high, and why does it continue to persist? And do you think the inflation that we're presently seeing will revert back to more acceptable levels?
So let's start, Joe, by taking a look at how inflation played out during 2021. This first chart on the slide represents the Fed's preferred inflation measure, which is the Personal Consumption Price Index. Although we haven't yet seen the December report for the PCE, it's fair to say that it will meaningfully exceed the Fed's 2% target for the 9th straight month. The chart on the right is what most of us view as the nation's inflation gauge, the Consumer Price Index. And as you said, Joe, this measure of inflation hit 7% year over year. There's no question that the Fed and others significantly underestimated the level of US inflation for 2021. Mohammed El-Arian is a prominent market commentator, and he's a special advisor to the German insurance giant Allianz. And he noted that this is the biggest miss of a forecast, of an inflation forecast on record. The table at the bottom of this chart represents the market's expectations for inflation for 5, 10, 20, and 30 years out. And as you can see, markets are expecting that inflation will average nearly 3% for the next 5 years. Now, this next chart looks at inflation rates for the three components that comprise nearly 3/4 of the consumer price index. Earlier this year, transportation and energy accounted for most of the CPI increase, but lately, we've seen a steady rise in prices for food, shelter, and medical services. So why are we seeing stubbornly high inflation? Let's face it. In our last webinar, I said that we're buying a lot more stuff rather than spending our money traveling, going to restaurants, concerts, or ball games. I said a lot of us have moved and we want to make changes to the new home we purchased. We're also working more at home and we want better equipment in our home offices. We're getting to those projects that we've put off for years. Our spending patterns have changed in a big way. This dynamic continues, especially since COVID gives no sign of going away. Economics 101 tells us that when the demand for goods and services go up and there's a shortage of supplies, as there are today, then prices are going to go up. Now, with the benefit of hindsight, it seems fairly obvious that inflation is a consequence resulting from all of this. But how long is it going to last? That's the question on everyone's mind. I've read numerous accounts that rent increases are certain to accelerate in the near term. Companies are feeling the pain of a severe labor shortage. Hence, we should expect upward pressure on wages for the near future. So I think, Joe, that we need to accept that inflation for at least 2022 could be meaningfully higher than what the Fed is hoping for. They continue to signal that they will act as required to rein in high inflation, but they are walking a tightrope. If they're too aggressive, they risk adversely affecting what many consider as an already fragile economy. If they aren't aggressive enough, they risk the unsustainable consequences of a prolonged inflation. So, Joe, no one really knows how long this current bout of inflation is going to last. We'll know more as the events of 2022 continue to unfold.
Great. Well, thanks for that color, Dave. For the listeners, we know that this is an important topic for you, and we'll continue to update you throughout the year and the rest of the quarter. So finally, Dave, let's talk a little bit about China. So as we both stated, the S&P 500 was up nearly 29% last year, yet some gauges at the Chinese stock market showed more than 20% declines. Why do you think there was such a big difference in returns, and do you think China still represents a viable investment opportunity?
Yeah, no question, Joe. China has been a disappointment recently. There are two reasons behind the poor returns we saw in 2021. First, and the most obvious, is China's zero COVID policy. It's remarkable to me that every day over the last few weeks, the US has reported 3 times as many cases in one day than China has reported over the entire pandemic. If Chinese officials detect but one case in a city of over 10 million people, they strictly lock down the entire city. And that means no one leaves their homes without permission except for the barest essentials. A second reason relates to China's crackdown on the tech sector. We discussed some of this during our last webinar. And I should say, Joe, that your question is one that we frequently discuss with our asset managers. But they remain convinced, as do we, that China's transformation to a prosperous society represents an excellent opportunity for investors. We will likely continue to see 2 steps forward and 1 step back, but we remain committed to maintaining exposure to the Chinese economy for a portion of the assets we steward on behalf of our participants and institutional investors.
Great. Thanks for that, Dave. It's a wonderful discussion in a complex and changing investment landscape.